Welcome back, everyone. I apologize for that. I had a little hiccup with my audio. Seems to be working fine now. So thank you all for your patience. As always, my name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thank you for coming to our weekly live, obviously live because our audio cut out and you got to see it all. But thank you for joining us every Tuesday at noon. We do these weekly updates, highlight what's going on in the market, and also bring you up to date on different aspects or different things we're seeing out in the financial world or in the financial planning and investment world. And today we're going to be talking about technology. There's a lot of press around technology. There's a lot of talk about it. So we're going to take a little bit deeper dive into that as well. As always, you can find information on this and all the things we put together at mikeonmoney.com. You can subscribe to our channels. Find replays of previous pieces that we've done, and coming very soon, my team is putting together, you'll be able to listen to these on podcasts. So if you'd prefer to listen to me ramble on about some things while you're running around in the car or out exercising or just getting a hike, you'll be able to do that as well. So we'll have information on mikeonmoney.com shortly as we get that system up and running. So before we get started, as always, remember this is just for educational purposes. Do not take it as solicitation or advice. Always seek the help of a professional or do your own due diligence before applying anything or any strategies to your portfolios, as everyone is unique, and you should definitely make sure that it's in line with your goals and your risk levels. So as always, you are muted and your monitor or your video is turned off. So don't worry about moving around and grab yourself a coffee. If you want to ask a question, by all means, click on the Q&A button. There should be a float-in bar that shows up for you, and type it in. We'll happily try to get to it today, but we will definitely follow up if we don't get to it today. If you're watching this on the replay, again, just go to the website, mikeonmoney.com, and you can send us in your question. Or give us a call. We're happy to help out any way we can. So let's dive right into things and see what's going on in the economy out there today. Well, a lot of news we're looking for this week. As we mentioned a couple of weeks ago, we kind of went into earnings week. So we've seen a lot of that out. We're also looking to see the October retail numbers for the U.S. U.S. import price index is coming out this week. Also, the industrial production and capacity utilization is coming out for October. Canada, we're looking at the housing starts numbers for October, and we're also seeing the SEC chairman testifying to the U.S. Senate, and that's a little bit of insider trading by perhaps some people in Congress and Senate ahead of the COVID pandemic news. Also, what we're seeing out there, so if you've been following the last week, we did see a bit of run up. Well, we saw some good run up, some new highs in the markets. A bit on the election, you know, the market is starting to really like the idea of they're seeing Biden out there talk about his transition team, who he's picking, and you know, a lot more confidence coming into, you know, having a little bit more of a stable presidency. You know, as far as information, as far as how things are handled. So the market's been moving up on that. And we also saw, as we mentioned last week, we saw Pfizer come out with their positive results on, or early positive results on their vaccine. But then, of course, we've seen another one, which we'll talk a bit more about today. It came out on Monday with even better results. Again, fairly early stage, but you know, much promising that we have 2 or 3 on the way here, and we're probably going to see a couple more. So the market traded up a bit on that. We have seen that edge down a little bit today, but more profit taken in certain areas, as we have seen a pretty good run up. Same with the Dow futures. They moved off a little bit this morning as a little bit of that exuberance is petering off from the vaccine trial numbers. Just that it's still not coming tomorrow, obviously. Soon, sooner the better. The market's still optimistic, but wanted more news as to when it's going to actually be delivered. Other things we're seeing out there is the IPO boom is not necessarily reversing. So going into the fall here, obviously this year there's been a lot of IPO or new stocks out there. Some fairly large ones. One was pulled in China, one of the largest ones ever. $34 billion one was pulled by the Chinese government. But we're seeing more and more, and that's not really slowing down too much, which is good for the equity markets, as we see no shortage of supply for the demand. And we're also seeing a lot of that demand into the equities, not just on optimism on the market, but pessimism on the bond market. Obviously, yields are not there. Interest rates are very, very low, almost zero in some cases. Great if you're borrowing money. If you have some debt, as we mentioned before, great time to go out there and refinance. But not great if you're looking for those yields in your portfolio. So people are turning to the equity markets to capture that. And so that's driving quite a bit of demand for that area. Support for MAX brand waivers as the Boeing jet nears the green light. So if you followed this, the MAX 8 plane with Boeing, of course, was grounded after 2 jets killing almost 300 or just over 380 people. They've been working hard to fix the problem and move into approval. They are looking to get a green light this week. As far as the regulators go, just to put those planes back into service. However, there's a little bit of chilling as far as the airlines go. One, I don't know that they've really gained the travelers' confidence yet that those planes are safe. But obviously, with everything that's going on in the pandemic world, with the numbers increasing, people are traveling even less. We're seeing way more lockdowns. Obviously, here in Canada, a lot more lockdowns, including the travel warning here in BC. Not a ban yet. However, we are expecting a news conference today at 4 our time, possibly Bonnie Henry introducing some more stricter rules. So obviously, with all that going on, the airlines themselves aren't excited about putting these planes back into service, because that means they have to start paying for them again, and they just don't need that capacity right now. So even though Boeing may get their green light, that might not end their troubles on that saga as they go through that. The U.S., talking about the pandemic, the U.S. did log 1 million new COVID cases in a week, and deaths were up 12%. So not a great picture. A lot of states are returning to lockdown procedures, including gyms and indoor dining. Kind of going back to the March, not quite at the March levels, and the fact that it's not as widespread. Some states are kind of staying open. Hawaii being an example, and their infections haven't risen that much. But for the most part, overall, we are seeing the U.S. Just careen out of control as far as the number of cases go. And that death rate number is increasing. Canada, the same. We're going to take a look at the numbers where we're also experiencing some pretty high spikes. Around the world, as I mentioned before, Biden's out there talking about what his presidency is going to look like. And he sees that, he's really started to engage with the business and labor market to work more cooperatively than the previous administration has about fixing the U.S. economy, really looking at bringing back jobs. He's talking about, the first thing that they have to tackle is the virus first, and whether that's the vaccine or getting it under control. But, a lot more focus, whereas the last administration seems to be, certainly currently it appears to be ignoring everything that's going on with the virus. But his administration seems to be very focused on getting it under control, working with business leaders, and getting jobs back into the economy again. And of course, fixing that job market and low unemployment has got to be job one, because that's what keeps your economy going is low unemployment. and the only way you can return to what they're calling a maximum employment level is really getting people out there, getting not just, we've got the virus to deal with, but also getting people out and using the services again, using products again. And we've talked a lot through these sessions. It is going to be different. We have seen a shift, I'd say a fundamental shift in the economy. We've seen a lot of disruptive technology kind of coming in and doing things a different way, better in a lot of cases. And I don't think that's going to end. I think that's actually going to accelerate, because what we've seen the pandemic do is take some people who were a little cautious about going using technology for different parts of their life, and then being forced to, because there was no other choice, obviously, and we still are currently in that situation in a lot of cases. And then they're getting comfortable with it, and that's going to continue, and that's going to drive those new disruptive technologies in existing markets. And we've talked about different ones, and I always like to use the best example is, I think, gyms. Of course, gym owners have had a real hard time through all this, obviously being closed and then being limited capacity and then reclosed again. But all through all this, we've seen companies like Peloton and Apple and Amazon, and I heard another one the other day, have come out and really taken hold of that home fitness market, where you can have your trainer online, really great quality, very diverse workouts, minimal home equipment to be able to do that. So, we've seen this massive shift, and that's just an example of a disruptive technology coming in and taking over a certain sector. Doesn't mean it's bad, but it does mean a shift. And people, I think it's going to be a long time before people become really confident about getting back to the gyms in full capacity. And that's just one example of what we're seeing out there. Also, this last week, OPEC plus, remember that's the OPEC group of countries plus other countries that they work with, other oil producing countries they work with. They earlier this year, when oil dropped to negative dollars per barrel, $34 per barrel, they all got together and they cut world supply, cut world production to reduce the inventories and bring the price back up again, which they managed to do. There have been some countries kind of cheating on that, which we knew that was going to happen. Some countries do require that revenue. That's their main source of revenue, and without that, they can't keep things running. So we've seen that. They did have the agreement until January, where output was supposed to increase again. Obviously, we've not seen an increase in demand around oil, so OPEC plus is pushing those countries to extend that for another 3 months or so. But they're very concerned that they're not going to get commitment from a lot of those countries who have already, given up a lot of revenue. And they can afford perhaps to sell it at lower prices than the current $40-ish a barrel US that it's going through. We're also seeing, kind of on that oil sector, a Saudi company, Aramco, plans to do a big debt issue, multi-tranche bond deal, and that's to shore up, their finances. They're bleeding. We've seen. There's another major company. I apologize. I meant to write down my notes. That they can't afford the dividend this quarter, so that they haven't been making enough money. So they're actually dipping into their cash reserves to pay that dividend, but very likely they're going to have to cut that dividend going forward. We've seen a lot of dividend cuts in the oil sector. We've seen a lot of slashes, and we've seen a lot of mergers, and this is just another example where oil is going to continue to struggle as we move through this pandemic shutdown, even with the optimism of a vaccine coming in place. So just glancing at these numbers again, the last few weeks, it gets harder and harder to look at it. The world is cleared through 55 million infected, 1.3 plus deaths, a million deaths. US has burned right through the 11 million mark on the infection number. As I mentioned, added a million last week. They're 11 million 5 total and growing, and total deaths well through the 250,000 mark. Canada, I remember, again, we've been watching the number for so long. We were around just the 200,000 mark, where we've well gone through the 300,000 mark and growing. And for so long, we stayed well below the 10,000 death number. And we're up through 11 now and growing as well. So obviously a lot of concerns with these numbers. And this list isn't complete, as I always mention. I truncate some countries out to fit to the slide, but Brazil's seen a massive increase in numbers. India's seen massive increase in numbers. Spain, Italy, France, England, are all seeing or experiencing new lockdowns due to the increased numbers. And I think the thing to keep in mind with this, I mean, yes, the infection rates are going up, but the real risk, and this is where some countries like Italy and Spain and France are getting very close to those critical numbers of ICU beds being taken up, kind of the critical care being taken up, because as we grow those numbers, that's when the serious cases can't get care, and we run into problems. The U.S. is definitely in certain states, they're definitely in those categories, especially in the Midwest. As we saw back in March and April with New York, we're seeing that now in the Midwest states. So that's what we're watching. That's what we're really concerned about when we're looking at those numbers, is how taxed is the healthcare system when it comes to being able to provide care for people who have it. So let's take a bit of a recap of what's going on here today. Obviously, the news was very promising for the S&P, the NASDAQ, and the Dow with the vaccine. We saw all those things do quite well last week. The US dollar remained little change. Again, we always talk about, we pretty much see a downward trend for the US dollar, just due to the overall economic conditions, the debt levels, the stimulus packages. But currently it's holding its own with those vaccine optimism around the vaccine. And also in gold, prices pretty flat, and oil prices pretty flat. When we say they rose or went down a little bit, very, very small marginal moves, as they've stayed pretty flat. As I mentioned, we're still in earnings week. Walmart is going to be posting. Expected to see good numbers from same-store sales. More and more people shopping. People shopping for bargains. So people shopping for your discount retailers. Dollarama is another one. We expect to see some really good numbers out of it as people look for better deals. Not so much so in the high-end spending, but definitely in your Walmarts of the world. Also, Home Depot, same idea. A lot of people doing home, as we stay at home more. A lot more people are doing jobs around the house, doing some remodeling. Whether they're getting a contractor and doing it themselves, but there's definitely more home improvement spending happening. We are looking at the U.S. Labor Department to show us some increases on the import prices, also on the export prices. We see a bit of inflation come through there. We're also looking at the retail sales numbers. And the retail sales numbers are expected to rise because we are expecting a much earlier holiday season shopping than usual, and for a lot of reasons. One, because people are very aware that if they're going to be ordering online for delivery, that the delivery systems are going to be very taxed. The couriers have all come out and said expect longer than normal delivery times. Stores are very well aware of that. And so they've been increasing or giving the sales earlier. You probably see it out there a lot right now. A lot of the big chains have already said, they're doing Black Friday sales, early this year, just to try to get some of those sales in earlier and be able to get the products out in time. So we'll keep a close eye on those retail numbers, especially as we head into the Black Friday with the U.S. Thanksgiving. Moderna, as I mentioned, their vaccine, the news came out on Monday. Very good news. Not just that, if you remember, the Pfizer vaccine was showing 90% effective. Now, again, keep in mind, these are early results. So the tests are not complete, or the studies are not complete, but very positive. I don't want to downplay them. I just want to keep them in reality check. So Pfizer's at 90%, Moderna's coming in 94.5%, which is even better. But the real big thing with Moderna, not just for everybody, but certainly for the smaller, less less affluent countries around the world. One of the big issues with the Pfizer vaccine is it had to be transported and stored at minus 70 degrees, which is, even your standard your standard restaurant freezer is only about rated to minus 40 degrees. So, special equipment, rural areas would have problems keep getting it there. All kinds of distribution problems. The Moderna does not have that requirement, so it doesn't have to be that low. So a lot more optimism around this one in the sense it can be distributed quickly with less cost. And obviously for countries that don't have the means of, say, a Canada or the US or a UK, that's better for them as well. In the banking sector, we're seeing Spain's BBVA exit the US, selling off to PNC, selling off the US-based banking business to PNC Financial Group. Again, this is just a story we've been hearing in a lot of sectors. Companies pulling back to their core business, cutting costs, trying to get through this pandemic with a strong balance sheet. Apple, if you've been following, of course, in Congress and in the Senate, we've seen all the tech giants, Twitter, Facebook, Apple, all being called in to testify, about data. And just recently, last week, we covered that Europe was hitting Apple with court challenges around their trust challenges, basically, around their online tracking tools. And we've also seen that with Amazon, where, how are they using that data? Are they getting an unfair advantage from that data? And are they tracking things that break certain jurisdictional rules? An Austrian group kind of came out in Europe going after Apple around those laws, the breach of the European laws, and Apple's pushing back saying, no, we're following all the rules. So there's a lot of things going on in the tech sector around this, and I don't think it's going away soon. Especially if you kind of look at the US, I always find it quite funny, when we have these 70-year-old people questioning some of the top tech companies in the world. It's almost be better if they brought in their own tech specialist to ask the questions, because I don't know that a lot gets done other than a lot of complaining in those cases. So we'll keep an eye on it. I don't expect it to be any big concern for Apple or Amazon or Facebook in the shorter term, for sure. The U.S. House is going to vote about FAA reform bill. So this goes back to what I mentioned about the Boeing 737. One of the things that came out of this study was the FAA, the certification process may not have been in depth enough or strict enough, which allowed for the 737 crashes to happen. So they've taken this time to kind of revamp the FAA policies and procedures to give an aircraft certification, and those are being voted on this week as well. So that'll affect Boeing, assuming that goes through. And Home Depot, as we mentioned, we're expecting to do quite well. In fact, they're out there spending $8 billion buying back HD Supply. HD Supply was their wholesale contractor business, which they spun off about a decade ago, and they're buying that back to bring it back under their umbrella. So that's pretty good indication that their earnings are going to be quite strong. Coming up in Canada, we're expected to see wholesale trade data. We're looking for that to increase. The Canadian Mortgage and Housing Corporation is scheduled to release the numbers on new housing starts. We did see that steadily rise, a little bit of slowing, but we do expect it to increase again for October. We have seen the pricing in Canada continue to rise, but the number of house sales has slipped a little bit. So cheap money, the very low interest rate is still driving the housing market in Canada. We're still seeing those prices up, but volume's starting to fall off. And that could be a lot of factors, just fewer people out there able to buy, but we're also, Canada, immigration is a big part of Canadian housing market, especially in BC. And obviously we've seen a big drop in immigration as people aren't traveling. Endeavour has become West Africa's biggest gold miner. So Endeavour is out there in the gold sector, as we've talked about. It's been doing quite well. We expect gold to continue to do well. This is just another acquisition as Endeavour is buying Teranga's gold to create one of the top 10 gold producers. So more consolidation in the gold market as they look to become more profitable at these higher prices. Alstrom's launching a $2 billion euro capital raise, and this is that Bombardier deal, buying the Bombardier rail business here in Canada. So they're looking to raise capital over in Europe to pay for that. And the Canadian banks and insurers are taking part in the climate change project. So they're getting together to discuss how they're going to finance climate change companies, so clean tech companies. This is not just a big push for Canada, not just our governments, not just our business leaders. We're seeing this globally. In fact, I'd say Canada's a little bit behind the rest of the world when it comes to this. Not just in investment, but in policy. And a big reason for this is not just, obviously the benefits to the environment, where we've talked many times about the fossil fuel sector on the decline. It's shrinking. It's not going to get back. It's not going away. It's not going to get back to its heyday as technology has surpassed fossil fuels as far as efficiencies. But if you look around the world, we're seeing countries like the UK saying by 2030, no more fossil fuel cars sold. Quebec just came out by 2035, no more fossil fuels will be allowed, or vehicles will be allowed to be sold. So we're seeing this push because the cost and efficiencies are better, are cheaper and more efficient in that clean tech environment. So the banks and the insurance companies are out there saying, hey, if we're going to be investing in this stuff, we want to really understand and map out what it's going to look like for the next 10 years. And that's where we're seeing them get together this week to talk about how to shift, especially the economy like Canada's, which still is fairly fossil fuel oriented as far as our GDP goes, and shift that to a low carbon economy. So it is happening. It is good news. As I said, from a global perspective, the fossil fuel market is on the decline. So it is well in our best interest in Canada to focus growth, new jobs, new sectors, new companies to be in that area that's going to dominate the world. And that's, the US, I think, is even further behind with the administration for the last 4 years, kind of avoiding any investment or any support for that sector. And that's one good thing, I think, with the Biden win or the Democrats win. They've committed to at least $1.2 trillion to invest into clean tech to start to shift their economy away from the fossil fuels and start to develop more technology around clean tech. So let's talk about the dollars or the exchange, the Forex. As I mentioned, we do see, despite the vaccine news and the dollar index holding, it was down a tiny little bit, but it's holding against its basket of comparables. But we do see a downward push. In fact, the latest numbers that we're seeing are estimations that we're seeing for 2021 as the US dollar could slide by about 20%. So something to keep in mind, when we're talking about currency is a risk in your portfolio. We've talked about different ways you can hedge that out, or use ETFs that automatically hedge them out. But keep in mind, currency is a risk. So a 20% slide on the US dollar can have an impact and possibly a positive play, depending on what side you're taking. The euro rose just slightly on some optimism there, and the sterling was a little bit weaker. And that just goes back to the Brexit negotiations. They keep on going back and forth between this is going to be good and smooth to it could be a lot of problems. The Canadian dollar, the last I checked this morning, was at 76.06, I think it was. So just slightly down from last week. And remember, we're pegged against the US dollar, so it does matter what the US dollar is doing as well. On the commodity side, we talked about the crude quite a bit already. We did see some of the oil stocks move up on optimism of the vaccine. I would not be tricked into buying into that rally. As I said, things are shutting down. The demand is not increasing. Even if the vaccine comes, we all know it's not overnight. It's not a magic bullet. We're not all just going to wake up tomorrow morning and be fine. It's going to be a while. I wouldn't be caught jumping too early into the oil sector. I think it's going to be fairly volatile for a while. The oil price, I think, was at 41, just over 41 a barrel this morning, and has been bouncing pretty much again because the OPEC pluses have closed down much of the production level. It's been trading, lows of $36, high of 42. Really hasn't been moving outside that range. And it's day to day dependent on how the virus is doing. As I mentioned, gold is a little bit lower on optimism around the markets, but again, as I think is a longer term trend, we do see gold being an inflationary hedge, and with all the stimulus packages that are coming out, and of course the U.S. with a new government coming in, they will push through a second stimulus package, which will push inflation a bit further, which is positive for gold, especially with gold priced in US dollars. So let's talk about our key topic today, technology. So investing in technology. And obviously technology has been a great win this year. Can you imagine if we went through this pandemic without our current level of technology, if this would have happened 10, 15 years ago, how difficult it would have been? Everything from food delivery to being able to talk to you in this manner, or even communicating to family around the world who can't travel. Obviously, technology has been a big factor, and we've seen that growth in that sector. Amazon was up 90% in 2020. Apple, one of our great holdings, has been up 80% this year. Microsoft, another good holding for us, 48%. The sector's been doing, just those three names have been up anywhere between 126 to over 200% since 2018. So a lot of growth in technology. Another example, we move away from just kind of the computing side. Tesla, we did a deep dive video on Tesla. If you want to talk about that story or hear about that story, it's moved up twice as much in overall value in market capital size than Royal Dutch Shell, which was one of the largest oil companies around the world, even though its revenues last year were about a 14th of that size. Same with Zoom. I'm talking to you through the technology of Zoom right now. Their market cap grew. The company grew to be worth 120 billion, up over 500% this year alone, on a forecast revenue of 1/10 of AstraZeneca, which has a market cap of 140 billion. Their stock only grew by 12%. So a lot of great growth, but obviously by those valuations, you can tell a lot of speculation as well. Because keep in mind, when we talk about the stock price, it's not trading on what the company is worth today. It's based on what people are estimating it's going to be worth tomorrow. So how much growth above what they're making today, how much more are they going to be making tomorrow or next year? That's what you're buying when you're buying the price. So that's saying that they grew so their stock price grew by 500% when you talk about Zoom. Did their earnings grow 500%? And is it going to grow another 500% next year? That's the big question when you talk about buying into these tech companies. Even though they've done great and we have them in our portfolio, we've done really well with them. We have trimmed some profits along the way and invested into other areas to take advantage of it. But keep that in mind. So with those valuations, are we getting into a bubble, right? We always hear that term bubble. Is it going to burst? In year 2000, if you've been around as long as me, you remember back in 2000 when the tech bubble blew, and we saw massive drops in tech names, devaluations, bankruptcies. We had a lot of momentum buying during that time. In fact, we've got one aspect that's kind of mirroring, and the next slide I'm talking about how we're different than 2020 or year 2000. So I don't want you to think that I'm negative here. I'm actually not. But I want to talk about, one of the problems we saw in 2000 was it was just the beginning of online trading. And when the technology bubble burst, the sad story behind that, not just, some people's portfolios went down a little bit and then recovered, but there was an increase of 70% of personal bankruptcies in the year 2000 because of people day trading, right? It was just the beginning of online trading. There was a lot of people trading online. And we often call that sector retail, but retail actually encompasses a lot more. But when we talk about this phenomenon, we talk about retail versus called institutional or portfolio managers, professional money managers. So when we talk about retail, we're talking about kind of the do-it-yourselfers, and not all of them. But what we saw in 2000, a lot of them, 70% increase in bankruptcies due to that online trading. And what we saw in the technology sector in 2000 was that overinflation. And if you remember back in those days, anything that came out with .com in the name, even if they made no money, one of the famous one was pets.com, right? They were selling pet food and pet supplies. They went out and did a big financing. It was called pets.com, massive IPO. Retail investors ran to it to buy it up in troves, driving the price up. They did a Super Bowl ad. They spent millions and millions of dollars on a Super Bowl ad, and only right after that just to go bankrupt because they had no revenue and they had no chance of ever creating the revenue that their valuations were warranted. So that that retail that call it a little bit inexperienced running towards the story instead of looking at the fundamentals. What does this company do? How do they make their money? Is that reoccurring? Can that grow? There's a lot of factors that go behind that. Well, today, one thing I'll say that before I get into how we're different, one thing I'll say we are seeing, and I'll use a name. I usually don't try to use a name, but and this is just an example. There's a company out there called Robinhood. This allows people to put, pennies, dollars, a very little amount of capital in, and they're able, it will allow you to go out as a group. So everyone wants to go out and buy a company. They'll bulk that together, so your cost is very, very low, and you get 1, 2, 10, 12 shares. So in principle, it's a great idea. It gets younger people involved. It gets the ability to invest in things at a cost you probably couldn't access that at. But where the risk runs, and we've seen this a couple of times, and I'm using Robinhood as an example, but I'm not picking on them, is we've seen run-ups in companies for the wrong reasons. Zoom being a great example. So as I mentioned, that Zoom stock, well, there's another company out there with the name Zoom, and we actually covered this at the time in one of our weeklies. That Zoom stock, which has nothing to do with Zoom, it was trading at pennies. It shot up from, I'm gonna try to go from memory, something like 45 cents a share to almost $4 a share in 2 days from the investors from Robinhood buying the wrong stock. It wasn't even the right Zoom. So they drove it up, 10 times in value, only to have it drop back down well below the 45 cents because there's no one to, everyone who owned it at 45 cents just sold out. They're like, I'm getting out of this thing because of such a win. We also saw them do the exact same thing with Hertz. Hertz Rental Cars filed for Chapter 11 in the United States, which is basically bankruptcy protection, or it is bankruptcy protection, meaning they were going to restructure all the debt and devalue all their equity. They came out publicly said, we're going to devalue all our currency or our stocks to zero, all our equity to zero, restructure and come out with a new stock under this new structure. And the Robinhood buyers went out and heard this new structure is going to be good and profitable and started buying up the old equity. So it drove up the stock by 70% in value. And the company was basically saying it's worthless stock, don't go buy it. But we see this retail kind of piling on to different areas of the market. So there is that risk right now that some names are getting that pile on effect from the retail investors. And we have definitely seen that in a lot of areas and sectors. So when I say we are different from 2000 to 2020, there's a lot of reasons we are. Yes, we've seen those prices go up. However, as a sector as a whole, the valuations are still quite a bit lower than 2000. We're also seeing companies being able to get access to cheap money. Interest rates are almost zero today. So, when you talk about companies' operating costs or carrying costs for debt or growth capital, they are able to grow at a much accelerated rate because they can get access to very cheap money compared to 2000. Also, underlying companies today actually have a huge advantage in the fact that they actually have a business structure. The .com was, as I mentioned, it wasn't really businesses. They were just, I opened a web page and I try to get $1 billion in valuations or $100 million in valuations. Today, we're seeing companies with real technology, real applications, and real revenues. So that's very positive. That means you're buying something real in a lot of cases. So that's much different than back in 2000. So that pathway to growth is very different and much more achievable. Also, we're seeing with the impact of the pandemic, as I mentioned, we're doing new ways. Technology is disrupting existing or old industries. Kind of a good example also would be Uber coming in disrupting the taxi industry. Very established revenue-based taxi industry, and Uber bringing a technology in that kind of disrupted, maybe more efficient. Obviously, they have their own challenges with that as they grow, but it is real. It is a real industry. So I'm not calling it a bubble, but I am saying if you are looking at all these windfalls in technology, sometimes take your windfalls for those really big wins and go look for a company that still hasn't seen as much growth or as a lower valuation, a lower multiple to its earnings, that has a great opportunity to take off. And again, don't always be thinking technology meaning your phone or your computer. Technology, as I've mentioned a million times before, is Visa, MasterCard, right? They're actually technology firms. They're not banking firms. They don't loan money. They just do the transactions. So they've done amazingly well through the pandemic, through this online purchasing, just acceleration of e-commerce. In our portfolios, another great win, CAE, which is a technology for training the pilots on the jets. Yes, people are flying less, but the pilots have to get recertified on the simulators on a regular basis. We were able to buy that stock just a few weeks ago at $20 a share, and it's over $30 a share now. So there are some great companies with very solid earnings and great abilities to go in there and take advantage of those gains. And so look for those in the technology market. If you see one that's growing by 200, 500%, like Zoom, maybe that's a good time to exit. Doesn't matter if you got the top. If you did well, be thankful, move on. There'll be another opportunity. You could do just as well or maybe better somewhere else. So don't get caught too much in that valuation trap. Or in that overexuberance of that kind of piling on as people jump onto a name that happens to be very popular out there. And as I always reiterate, if you like a certain sector, if you want to get access to different areas of the market, don't discard ETFs. They're a great way. We just did a deep dive. We released out Friday, Monday this week on cybersecurity. One of our a great position in the portfolios. It's up like 40% for us this year. We've held it since early 2019 as well. It's a growing market. Just think about all this online, all this e-businesses. Every company out there has to protect themselves. Cybersecurity is a non-discretionary spend for companies. Cyber, CYBR, is one of my favorite ETFs for that area. We did a deep dive. I interviewed the CEO of Evolve ETFs who started cyber. Another one, if you like the electric car sector, they have one called Cars that focuses on that sector. There's one on e-game. If you want to get access to these different technology sectors, you don't always have to go try to pick that one winner. Sometimes there's some really, really good ways in an ETF to get access to it. And as I mentioned, you can also hedge out currency in those very effectively. Cyber is offered both in a US dollar and a Canadian dollar version, so you can take currency risk out. So don't discount ETFs when you're talking about technology. And do go check out that cybersecurity video we did. Raj is a great speaker, very knowledgeable on the subject, and we had a great back and forth talking about the industry as a whole and why it's a great opportunity, not just today but going forward. So as I mentioned, there's a lot of signals out there that still say technology is a great place to be. Just let's be smart about where we put it, and let's make sure we take profits when we can. Look for those pullbacks to jump into the market and go from there. One thing I just want to mention also on technology, and this is more on a personal note, maybe something we can all think of. We are headed into the holiday season, and I know a lot of people, are looking at buying online and having things delivered and everything. As we go into this the height of the second wave pandemic, our local businesses are suffering. And I know for years it's kind of gone where we peruse our local businesses and say, oh, I like that, and then go home online and search and find it cheaper online. I don't know that the price difference is that big, but certainly the convenience of online now is there, and we're obviously the numbers are showing us that more and more people are doing it. But maybe for some things this holiday season, maybe we can find it online and then contact our local stores and try to help them out. They're doing curbside pickups. You can do safe pickups. If you call them and order it, they'll have it ready for you. You can pay it on their website. But obviously, local businesses need help. We talked about this in the first shutdown. About try to help your local restaurants. Buying gift cards if you can for future use. Any way you can help out with our community, I encourage it. So that's just one idea for your shop. And as always, as we mentioned earlier, keep in mind charities this year. The food bank's obviously going to be under a lot of pressure, especially we go into another shutdown with more layoffs happening. So keep that in mind. So with that, I'm going to let you go because I rambled on too long this week. But go to mikeonmoney.com if you want to find those other videos. Sign up for any of our notifications and check it out next week. Like I mentioned, we should have our podcast information up where you can listen to this without having to sit in front of your computer. With that, thanks everyone. Have a great week, and we'll talk soon.